Testing, testing. Okay. Just make sure the sound is good. All right. How do we sound? Sounds good on my end. Okay. Just got to get my windows right. Okay. Not quite right. Let me get this sized correctly. Sorry, guys. Bear with me for 1 second. There. Okay. I think we're good to go. All right. Just give it another minute to let everybody filter in who wants to watch on Christmas Eve. Okay. If anybody is there in the chat, let me know if the sound is okay or if it sounds off. Okay. I think we're just going to roll. Okay, this is my public YouTube investing series where I'm investing in a different company every week. Year to date, we are beating the S&P 500 by a decent amount, about 5%, which I am very happy about. And we're not just picking a few stocks. You can see every single week, we've got nearly 50 stocks now that we've picked. At the beginning, it was very volatile, but as we have gotten up close to 50 stocks now, it is starting to match the performance of the S&P 500 a little bit, but we still have a little bit of an edge. So very happy about that. This week, I'm going to be continuing my search for deep value companies. I have been looking at companies that are trading with very low volume and companies that are very low market cap for two reasons. Number one, they are not picked over. People are not paying attention to the small caps and the companies that are trading low volume. The traders don't go there. So with fewer eyes on these companies, it's just much easier to find companies that are very deep value. And this is in terms of their discounted future free cash flow. That is the primary model that I'm using to value companies, to calculate their approximate intrinsic value. Now, this week, I decided to branch out a little bit. I realized that this also goes for companies that are in other countries. Now, a lot of investors are mainly focused on the United States, especially investors like myself who are living in the United States. I'm more familiar with companies in the US, and companies outside of the US can be out of my comfort zone a little bit. And for that reason, it's out of a lot of people's comfort zone. They are not as picked over as well. And there are some like incredibly deep value companies that are in other countries. Now, I'm realizing now I said there were two reasons I'm looking at small cap, low volume in other countries. Also, if they're small cap and low volume, big hedge funds, big money cannot invest because the very act of investing, if a company has such a low volume, the very act of investing will push the price up, and it'll no longer be a value company as you start trying to put a lot of money in. But for somebody like me who's only investing small amounts of money, I can invest freely without worrying about pushing the price up outside of the value range. So now here's the stock screener that I've been using lately to find value companies. I'm looking for small caps between 300 million and 2 billion market cap, price to book ratio of under 1. I just have the industry filter on there so I can see what industry the company is in at a glance. I like net cash, which means they have more cash on hand than they have debt to pay. And I like to see some revenue growth. So those are my primary filters. But this week I am looking at outside of the US, and this is the company that I found, AFYA Limited. Now, I'm on the forecast tab right now. You can see that most analysts like the company. As I scroll down, I can see this is one thing I love to see is future revenue growth. On average in 2025, the average analyst opinion is about 15% revenue growth, and the average opinion going forward is upper single digit revenue growth. I really like to see that. When I go to the financials though, I go to the balance sheet. Now this is in the Brazilian currency, so I am taking into account the Brazilian currency. This company's in Brazil. But another thing I really like to see is cash, 996 million. Whenever I go to their long-term debt, 996 million. So this company is clearly planning to pay off a lot of debt. That takes a lot of risk off the table, in my opinion. When I go to their ratios tab, this is another thing that I love to see. Relatively low price to book ratio. This company does not quite meet my price to book of less than 1. However, their price to free cash flow is incredibly low. And free cash flow is the main thing that I'm looking at when I'm valuing a company, because free cash flow is the amount of money that a company has every year to reinvest and bring about shareholder value. They can use that cash to pay a dividend or do share buybacks, or they can pay off debt, or they can expand organically through capital expenditures or inorganically through acquisitions. There's lots of options, but free cash flow is the amount of money that is going to bring about more shareholder value in the future. So that is what I like to model. And their free cash flow yield is growing every single year. This is what I like to see. So if we go back, this is 2019. This is the first year that they had positive free cash flow yield. Every single year, nearly, it has been rising. A free cash flow yield of 10% is considered to be exceptional. They hit that, and they've been exceeding it every year. On top of that, their return on capital, their return on assets, their return on equity, all of these figures are going up every single year for the most part. On average, they're going up. So if we look at this year right here, this is in 2021, been consistently, every single one of these metrics have been consistently going up since 2021. So I love to see it. Okay, so really quick, let's go to the actual calculation for free cash flow, discounted free cash flow valuation. So this valuation has two primary parts. Number one, I need to project the future revenues of the company. And number two, I need to project the free cash flow margin. This is the percentage of revenue that a company is able to generate free cash flow. So for the free cash flow margin, currently I'm using their average free cash flow margin over the previous 5 years. So that would be 30.5%. However, I do a couple adjustments to the free cash flow margin. Sometimes I give them credit for capital expenditures. Sometimes I give them credit for R&D. In this case, I'm not giving them any credit. Sometimes I count against for acquisitions, because if a company is growing their revenue inorganically and they're doing that consistently, sometimes there is an issue where they are buying companies for the sake of growing, but it's not synergizing and it's not necessarily increasing their free cash flow margin. And in fact, a lot of times when you see these serial acquirers, their free cash flow margin is actually going down over time. And so in that case, I would be counting acquisitions against. However, in this case, I have seen nothing but free cash flow margin going up, and the nature of their acquisitions is in line with their business, which I'm going to get into shortly. So not counting against on acquisitions. And then finally, and I've got the titles over here: R&D, CapEx, acquisitions, and stock-based compensation. Stock-based compensation, I am counting 95% of their stock-based compensation against. And just to show really quick why I'm doing that, if we go to the cash flow statement, to calculate the free cash flow, you take the operating cash flow and you subtract the capital expenditures. Now, one figure that goes into this operating cash flow is stock-based compensation. So they start with net income and then they start adding back in non-cash expenses. And one non-cash expense is stock-based compensation because they're giving their employees stock, not cash. So cash isn't necessarily leaving the company. However, it does represent an expense on the income statement, but on the cash flow statement, it doesn't count as cash. So this number will bolster their free cash flow. And then if we go further down, if we go to the financing the financing cash flow category, they're then spending cash to repurchase the stock that they just gave out. So it's like compensating their employees with extra steps. So I still count free cash flow against. So given these adjustments, their new average is 29%. Okay. Now, one quick note, we can see that going back to 2020, it was 20% free cash flow margin, and then 27, and then 28, and then 31, and then 38. So their free cash flow is trending upwards. However, just to be conservative with this valuation, I'm going to use the average free cash flow margin over the last 5 years, which is 29%. Now, the next thing that I need to project going forward is their revenue increase. So initially, I always set my screener initially to be 2% revenue growth for years 1 through 5, 2% revenue growth for years 6 through 10, and then 2% growth for my perpetual growth rate. I use this just to see is the company undervalued or overvalued, assuming that they do not grow with respect to inflation. So if I say, let's assume 2% inflation, in reality, inflation may be slightly higher than that. It might be 3%, it might be 2.5%, who knows? Let's just say it's 2% going forward. If they're able to just keep pace with inflation, what does their free cash flow valuation look like? And then this final cell that I'm taking into account is the discount rate. This is my return on investment that I want every single year. So what price should I pay for this company to achieve an 8.25% return every single year? And my projection right here, this cell is this is the calculation. So if these assumptions are reasonable assumptions, then the fair share price of this company is $43.20. The current share price is $14. So what does that tell me? It tells me that the market is pricing this company as if it is going to be shrinking into the future. So my current assumption is based on some growth and maintaining a certain free cash flow margin. And if they're able to do this, right, if the company is able to do this, then their share price should be 43.2. So initially I'm thinking like, oh my gosh, like something's got to be wrong here. What am I missing? And just so you're aware, I am including the what am I trying to say? Going from the Brazilian currency to the USD. That calculation is right here. So 0.1 Brazilian real equals 0.18 USD. So that has been taken into account right there. So, okay. So clearly, if this company is projected to shrink, then it would behoove me to know, okay, what does the market think that is going to happen with this company? So how can I tweak these assumptions so that my projection right here is showing the current share price? So number one, let's cut the free cash flow margin in half. Let's say basically they're peaking right now in terms of their margin. It's going to be dropping into the future. I'll put that at 15%. And then given that assumption, by the way, we are still 31% overvalued. Now let's make 0% growth going into the future. Okay. So at half the free cash flow margin and 0 growth going forward, the company is trading just slightly overvalued. The fair share price would be $12.65. So let's say we have a free cash flow margin of 20% going forward, and then we have revenue shrinkage of, say, 2%. Or no, let's go 1% and 1%. So here's another possibility. The market is pricing this company to have a 20% free cash flow margin and shrinking revenue by 2% every year for the next 5 years, 1% perpetual and or -1% and -1 for years 6 through 10. That's another possibility. We can also say maybe they're going to maintain their free cash flow margin, the average over the next 5 years. And then what would they be shrinking at? 5%? They would be shrinking at 5% in that case. That would give me a 16% free cash flow margin. So I always like to do that exercise to see what does the market think this company is doing. And then I look at all of my research, all of my due diligence on the company, and I'm trying to convince myself, is the market correct or is the market wrong about this company? So the first thing I want to attack is the free cash flow margin. So first of all, they have been consistently growing their free cash flow margin. After doing my due diligence, and we're going to get into some of the research that I've been looking at, some of the documents that I'm looking at, I don't see any evidence that they are going to be shrinking in free cash flow margin. In fact, it's growing, and I think it would be probably more accurate to use a free cash flow margin that's a little bit higher than 30%, just because that's where they're headed. However, I want to just keep it at 30%. So let's leave the free cash flow margin where it's at for now, and let's look at their revenue growth. So what do the analysts say again? Let's remind ourselves, what do the analysts believe that the revenue is going to be doing? The analysts believe the revenue is going to be going up. In fact, the lowest analyst opinions are quoting 9% growth in 2025, 3% growth in 2026, and then 0% growth in 2027. So let's take this assumption for a minute, and let's assume that the company continues on this trend of dropping revenue, even though in 2025, they're on track to make quite a bit. So let's do that experiment really quick. So right here, this is where I enter in the analyst projections. So right now I have their 3 years, and then these two, I can't find projections that go out 5 years for this company. So I'm going to have to enter these in myself, but let's say it goes -3 and then -5. Let's say this is the trend. So now with the analyst low projection, I am still seeing a 56% upside. And just to keep in mind, that's using the next 5 years. That's years 1 through 5. That's using the analyst projections. And then for years 6 through 10, it's using my projection of losing 5% revenue and then a perpetual shrink of 5%. And given those assumptions with the free cash flow margin where it is, I'm still seeing a 56% upside on this company. And that's 56 on top of the 8% return that I am assuming every single year going forward. So based on the analyst projections, this company is looking insanely undervalued. Now, I think the analysts also forecast earnings per share. Now, the analysts, the average analysts are showing increased earnings per share. The lowest analysts are showing shrinking earnings per share. So that's the next thing I want to build in is what if we do start to see free cash flow margin decline. So right here's where I can enter that in. Let's say they start losing 1% per year every year for the next 5 years. That would give me it would still be 30%, undervalued. If they lose 2% per year, that would put me at 3%. So if the lowest analysts are correct, we see shrinking free cash flow margin by 2% every year for the next 5 years. That would mean after 5 years, they're at a 20% free cash flow margin. That's lower than they were, by the way, 5 years ago, about the same. And then they're losing 5% revenue at the end of the 5-year period. So that is what the market believes about this stock. The market is in line with the lowest analyst projections. The analysts that are on stockanalysis.com at least. So let's look at some other analyst projections. So right here, this is the LSEG Stock Report Plus. Since I am an investor with Charles Schwab, I get access to different analyst reports. This particular report gives this company an average score of 10. They give it a buy rating. And if I scroll down just a bit, we can see some of these projections. Price target, the analysts on LSEG, there's 7 analysts that are weighing in. They seem to like this company. If we go to their earnings per share, looks like the lowest analysts are seeing a drop off in earnings per share, but then a rise after that, whereas the average analyst projections are showing basically in line for 2025 and then rising going into 2026. So the analysts on here, on average, they're projecting increasing earnings per share. And if I keep scrolling down on the revenue projection, so for 2025, all 8 analysts are in line. They're going to be making about 3.8, 3.7 billion in the Brazilian currency, the Brazilian real. And then into 2026, they're assuming another 10% revenue growth. So the analysts on here are pretty much unanimously agreeing that this company is going to be increasing their revenue, at least going into 2026 and for the rest of 2025. So that's looking pretty promising. The next report, CFRA, this is a quantitative stock report, gives it a strong buy rating of 10. I don't know that this one actually gives me any analyst projections. Hokage, sorry, I just saw your comment. What is the average volume on this? Sometimes hedge funds do invest in small caps to short it as long as there is sufficient volume. What matters is no outstanding shares and price spread. Let's look. That's a good question. What is the average volume on this? And even if, see, and I want to say this really quick. If we have a small cap company that hedge funds are, let's say they're bullying the stock price, they're shorting it, they're keeping it down. If the company is growing, eventually it's going to be big enough and it's going to eventually garner enough attention that all of the months or years that the hedge fund is keeping this price artificially lower, that's just going to create a better and better buying opportunity for me, a small investor who's taking a small percentage of my portfolio and putting it into an individual small cap stock. That does represent more risk because it is smaller, to your point. It does carry, I guess, low volume risk. But the way I see it, if I have a long time horizon and I'm properly diversified, I see this low volume risk as an opportunity. And yes, this company does have very low risk. I'm pretty sure small caps, you want to see it typically at least 100,000 in volume. So this is a bit low. So yes, it does have low volume. The market cap is 1.3 billion. So it is on the upper half of small cap. Small cap goes up to 2 billion. So it's starting to get closer to the mid cap range. And if it does continue on its trajectory, eventually this company is going to get into the mid caps. And once it's in the mid caps, it's going to start getting more attention from long hedge funds, long institutional investors, and so on. So that's my opinion. Stay diversified though on these. That's my outlook. I like to stay diversified. So, if I'm going to be taking a position in a high risk, high reward company, it's not going to represent a massive loss if it doesn't pan out. So yes, indeed. Okay. Where was I? Oh yeah. I don't think there are revenue projections on this particular report. This is a quantitative report. It gives a strong buy. I don't think there are, but I just wanted to quickly go through that. So what does this company do exactly? Let's look at this is their most recent quarterly report and their full year guidance for 2025. So this company, let's see, where is the best synopsis? Which synopsis do we want to look at? I guess we can just do the synopsis here on the overview. AFYA Limited operates as a medical education group in Brazil. The company operates in 3 segments: undergrad, continuing education, and digital services. It offers educational products and services, including medical schools, medical residency, prep courses, graduate courses, and other programs to lifelong medical learners enrolled across its distribution network, as well as third-party medical schools. The company also provides digital health services, such as subscription-based mobile app and website portal that focuses on assisting... Where was I? Lost my spot when I had to hit that link. Assisting health professionals and students with clinical decision-making through tools such as medical calculators, charts, updated content, as well as prep, clinical scores, medical procedures, etc. So this is a medical education company, continuing education, undergrad prep, etc. You get the idea. So how does this company grow? That's the question I want to look at. The analysts are saying This company is going to grow by single-digit revenue, low single-digit revenue for the next couple of years. This company, if we go to their, let's go to their forward-looking statement, their guidance. So they are quoting revenue guidance of about 3.7 billion. If I go to their previous year revenue, they're at 3.3 billion. So that's over 10%. So this company is saying, at least for 2025, they're going to be growing by at least 10%. Let's see. Segment information. Okay. This company has 3 reportable segments: undergrad, which provides educational services through undergraduate courses related to medical school, undergraduate health science, and other ex-health undergraduate programs. They also do continuing education, which provides medical education, including residency prep programs, specialized test prep, and other medical capabilities, specialization in graduate courses in medicine delivered through digital and in-person content. And then finally, medical practice solutions, which provides clinical decision, clinical management, and doctor-patient relations. So one of the big ways that they are growing is by increasing the number of seats that they have available to bring in students. And this is where their acquisitions comes into play. I mentioned earlier that this company they have a lot of acquisitions on their cash flow statement, and I wanted to talk about why I'm not penalizing this company for their acquisitions. So let me go down really quick. Okay, so over the trailing 12 months, this company brought in 1.56 billion in cash from its operations, and it spent 167 million on CapEx. It acquired 265 million, which is actually less than what it did in previous years. We see 1 billion, 300 million, 900 million, 700 million, and then purchase of intangibles. I'm not sure what that is. So over the trailing 12 months, about 600 million of that 1.5 billion went into growth as far as for the acquisitions category. And then their financing, they are paying back their debt, 352 million. They are paying some dividends now. This is their first time paying dividends, and they are buying back some stock. Okay, so one thing about companies now, this kind of goes into what you were saying, Hokage. Yes, I just saw your comment. You said, I think it is not in USD. You're right. These financials are not in USD. All of these financials, when I'm doing my calculations on the spreadsheet, I am converting them right here. If I type in a 1 right here, you see it changes all the numbers, but I've got 0.18 because that is, what am I trying to say? That's the conversion to USD. Okay, but the stock price is in USD. Like this information, when I go to the overview, all of this information is in US, or at least the stock price is in USD. Yeah, USD right here. Anyway. Okay, on the financials, cash flow, let's see, where was I? Okay, so they are paying back debt. They started paying dividends. Now, one thing I like about a company that is paying dividends is the dividend, especially in a small cap company with low volume, the dividends act as sort of a pricing anchor, like a value anchor. If the company is starting to, like, let's say these hedge funds are shorting the company, they're pushing the price down. As the price falls, assuming that share price falling is not linked to the performance of the company, let's say the company is still performing as strong as ever, the dividend yield is going to start going up as the hedge funds push the price down artificially. Okay. So as a company starts building its dividend, if the dividend yield becomes too high, then that's going to be a force to bring in more investors as they're looking and they're saying, hey, this company has great financials. They're paying a 10% dividend. What's going on? I'm going to start investing. So a dividend is one thing I do really like to see in terms, like, it just creates sort of a stock floor for me. In situations where I might be worried about hedge funds bullying the share price or shorting institutions bullying a share price. Now, speaking of the dividend, it's not super high right now. It is only 1.58%. They just started paying their dividend. And then we're going to look a little bit further for their plans as far as capital allocation. What are they going to be spending their money on? Is it going to be share buybacks? Is it going to be increased dividends? We're going to look at that shortly. So where was I? Okay. So I was talking about acquisitions. So they are spending a lot of money getting additional seats so that they can bring on more undergraduate students. And we're going to look at that right here. So undergraduate programs right here, medical school, approved seats. So we can see the change. Approved seats in 2024, 3,593. Approved seats in 2025, 3,653, a 1.7 increase. Their total students has increased by 6% going from 2024 to 2025. Their average total students has increased by 11%. Their revenue has increased by 14% in this undergrad medical school program. In their health sciences program, their total number of students increased by 4%. On average, 5%. Other ex-health undergraduate students increased significantly, this one by 25.9%. So we can see that they are increasing their total number of seats, which is increasing the number of students that they can bring in, which is increasing their revenue in this particular segment. So that is what their acquisitions is going towards. Here are some key revenue drivers. For the continuing education, looks like their continuing education did not fare as well. Residency dropped by 36%. Graduate journey, business to physicians. So yeah, residence journey and graduate journey. It looks like their graduates increased by 26%. Residents dropped by 36%. At the end of the day, they decreased their total students by 4.6% in continuing ed. However, their revenue is still up by 10%. And so they have pricing power in that case. And maybe that is why they lost some of their students as they started increasing their pricing. Okay, some more key revenue drivers. So the next thing I want to look at is what actual acquisitions did they make? So bear with me for a second. Let me go to their acquisitions. Oh, there we go. Okay. So in 2024, on July 1st, they acquired Unidom. Unidom is a post-secondary education institution with governmental authorization to offer on-campus undergraduate degrees. This acquisition contributed 300 operational medical school seats. So that's an example of one of their acquisitions in 2024. In 2025, another acquisition. This one represented 60 medical school seats. So this is what they're doing. They're increasing their number of seats, which is good for their undergrad segment. So what I'm seeing is continual growth through acquisitions. I would call it organic growth, even though it's technically an acquisition. A lot of people I guess they call that inorganic growth, but it's in line with their business model. It's highly synergistic. So I'm happy with the way that they're spending their money. That's a good investment in my mind. So this company is creating tons of free cash flow. They're reinvesting it in the form of buying seats, acquisitions, increasing future revenues. They also have a plan for share buybacks. So let me go to that really quick. Let me scroll down. This is on their most recent quarterly report. Bear with me. Talking about CapEx. Did I scroll too far? Oh, key events. Okay. On August 13th, 2025, the company's board of directors approved a new share repurchase program. AFYA may repurchase up to 4 million of its outstanding Class A shares. So what exactly does that represent? Their total shares outstanding. Where is it? Shares outstanding, 90 million. They're saying they are willing to buy back 4 million. That's about 5% of their shares outstanding. So 5% increase in my shares purchasing power, or voting share, or whatever you want to call it. So that is a significant share buyback program. So this company is number one. They're looking to do more share buybacks. Let me see what they say about the dividend. I don't remember if they went into that in this. Oops. Okay. I don't know if they talked about whether that was going to increase or not. It doesn't look like they discussed whether or not they were going to increase their dividend on this particular earnings report, but they have started paying a dividend. So with all that in mind, I need to look a little bit further into their future plans for dividends. But given this scenario, right, this super bearish scenario with the lowest analysts, we're looking at a 3% upside on top of this, basically fair priced. So if I want a 8.25% return, then I'm willing to buy this company at $15 per share. I believe that this outcome is not realistic. I think we're looking at a 30% free cash flow margin. I do not think they're going to be dropping their free cash flow margin. I think it's reasonable to assume that they increase their revenue by just 2% per year, given the average analyst expectation is much higher. It's nearly double-digit revenue growth. So just a 2% revenue growth as a base case with an average free cash flow margin going forward. This represents a 200% upside. This is the perfect example of a deep value company. Yes, it does have some risks. It's a small cap company. It's in another country. It has low volume. Yes, these are all risks. There's also a significant potential reward. One aspect that also reduces the risk of this investment is that it is so undervalued. This company makes so much money compared to what its share price would imply. So that brings down the risk for me. And the fact that I am investing just a small percentage of my portfolio into this company. I invest currently throughout this year in 2025, I've invested $100 per week in a different company. Going forward in 2026, we're going to up the investment to $250 per week. Currently at about $7,000 in the YouTube portfolio. So I'm looking forward to 2026, seeing how quickly we can grow the portfolio. Hopefully we'll be able to continue beating the S&P 500. Currently we are up year to date about 24%. The S&P 500 it's only up about, I believe it was 19%. Let me pull up the portfolio again and we'll review the portfolio real quick. I'm going to have to log in again. Instead of going by memory, I'll just pull up the portfolio. Okay, here we are. Okay, this is the YouTube portfolio. We've got $7,000 in the portfolio. We've got 100 in cash. We've got 6,900 invested. We've been going up nicely all year. The current performance year to date, let's compare it to the benchmarks. Let's add the S&P 500 in here. For some reason, it's not a default. So the portfolio is up 24.6% year to date. The S&P 500 is up 19.19% year to date. So we're beating by about 5.5% going into 2026. That is the goal. You can see, let's go back to the portfolio. Let's look at the holdings. Currently, we have 45 different companies that we're invested in. So it's not like we're just investing in a couple and, we're able to just barely beat the S&P 500. No, we've invested in tons of companies at this point. We are still up every single week. I'm going through the same due diligence process where I am starting with a screener or starting with a concept or a trend, finding a company that fits nicely in that trend that has a discounted future free cash flow valuation that is much, much, much higher than the current share price would suggest. We are doing this every single week, and so far we have been doing it to great success. So we've got a few companies, though. When you pick so many, there's going to be a handful that do not perform well. Like I said, this is the company that I'm investing this week, putting $100 into here. Some of these companies still have very high conviction in, even though they are currently down. In fact, some of these I have doubled down on. You can see PayPal and Nice. We've invested $300 into each of these. So I've actually doubled and tripled down on these companies. And with a value investing portfolio, it is not about a quick return. Yes, it is nice to beat the market over the course of a year. That is nice to see. However, I have a long-term investing approach where I'm trying to beat the S&P 500, beat the stock market over many years, not necessarily just 1 year or 1 month or however long. Oh shoot, the TV just turned on. Okay. So yeah, Point is, sorry, I got derailed there. The point is, I have a long-term investing mindset. So just because I have a red section down here, I do not view these companies as bad investments yet. My process for getting out of an investment that has not turned out well, or an investment that's turned out too well, for instance, would be to run the valuation procedure once again, to look at their discounted future free cash flow valuation. If their current share price far exceeds what I'm coming up for with as a valuation, then at that point I would exit the position. Now, it is the case in these stocks down here that I am considering them still to be undervalued. In fact, more undervalued than I initially bought in at. However, I'm not just going to infinitely double down and triple down, because I am trying to keep my diversification such that one company isn't going to tank my whole portfolio. If I am wrong, or if something does happen that, there's always going to be insider information that you don't see. The market sells off and then you have access to the information after the fact. It happens. So it's good to have plenty of companies to just kind of soften any big misses that you may have. So that's the portfolio. If anybody has any companies that they'd like me to look at, I'd be happy to do a quick discounted free cash flow valuation, just a very surface level analysis, not diving in too deep, just looking at what do the analysts think, what is the current share price, what's their current free cash flow valuation. We can see, does the company look at first glance overvalued or undervalued? Is it an interesting company to do a deep dive on? And that is one of the beautiful things about using this automated spreadsheet is I can type in any ticker. Let's do Google, for instance. I can use their most recent average free cash flow margin. I can make sure that it's in USD, of course. Let's see. And I have screwed something up here. Oh, I know what I did. Sorry. Bear with me. These shares outstanding. The shares outstanding is also automated. Oops. Okay, there we go. That's better. Okay, so given Google's average free cash flow margin of 23%, just at first glance, if they were only growing at 2% per year, then they would be massively overvalued. Of course, we all know that Google's growing much faster than 2% per year, but just to give an example. So let's just say they're growing at 10%, 3% perpetual growth rate, 10% over years 6 through 10. So if they had a double-digit growth rate for the next 10 years, they maintained their free cash flow margin, and then had a 3% perpetual growth rate, then they would be slightly overvalued today. So with this automated spreadsheet, I can do a very quick check on just many different companies, given a few basic assumptions. And if the company is showing to be incredibly undervalued, then I like to do a deeper dive on that company. So anyway, if nobody has a company that they'd like me to look at, I think I'm going to go ahead and call it. It is Christmas Eve after all. Excuse me. Yeah, Hokage is actually just echoing that. It's Christmas Eve. Your family will be angry if you make them wait too much. This was a great year. Glad I came across your channel in February. If time permits, please share the updated Excel spreadsheet. We'll do that. I will absolutely do that. This is, I'm pretty sure, I don't know, Hokage, do you mind telling me, was this feature in the previous spreadsheet that you have, this conversion here? The only thing I was tinkering with for this video is if I go down to the data entry, the discounted free cash flow tab, this is where all the calculations go down. Sometimes the shares outstanding is not updated on stockanalysis.com. So sometimes I will, just to make sure that it is more accurate, I will input manually the shares outstanding. I think that's the only adjustment that I've made since sending out the latest spreadsheet. But anyway, send me an email on my Money Necessity email, and if you want the latest update, I'll reply to you on that email with a link. Oh, okay. So Hokage is saying no USD conversion and new way to enter initial free cash flow. Oh yes, the initial free cash flow. Okay, absolutely. I will make that available to you. Send me an email though, please, so I don't forget. And yeah, we'll get you the latest update. Hokage, as always, thanks for tuning in. I appreciate you, and have a Merry Christmas. Everybody else who's watching this video, have a Merry Christmas, and we'll see y'all going into 2026. Hopefully we can have another really great year. Good night.